Having money in your hand has always meant more than having it under your mattress at home. Those with cash are in a better bargain position. If you want to buy a property, you'll negotiate a discount and get ahead of the mortgage seekers if you are holding cash. The saying "cash is king" is spot on here. Yeah. Vincent. Welcome to Invest with Jiri. Today we'll discuss why holding cash is not long-term investment and answer questions like: why is cash is king not valid in long-term investing? Why invest when a savings account has 5% interest? How to maintain the value of cash? What about the volatility of the markets when investing in stocks? What is the main use of cash? If you don't already subscribe to Invest with Jiri, click subscribe and ring the bell so you don't miss any of my other videos, and let's get to answering today's questions. Why is cash is king not valid in long-term investing? There are several misconceptions about cash and especially its role in long-term investing. One of the most common is the belief that cash is always a safe choice and represents a guarantee for preserving value. Cash loses its purchasing power due to inflation. This means that the money you hold today will be worth less tomorrow. Yes, $100 is still $100, but what you buy with it won't be the same tomorrow. Take a look at the dollar's worth chart at visualcapitalist.com. A dollar today could buy you 10 bottles of beer in 1933, while in 2020 the same dollar will buy you just one coffee at McDonald's. What this means is that the value of $1 is decreasing over time, and this is mainly due to inflation, where more and more money comes into the economy and the goods and services become more expensive. Another misconception about cash is market timing. The belief that holding cash is the best way to respond to a market downturn is false. The reality is that investing in assets with growth potential can provide much better results over the long term than holding cash with the intention of investing it profitably. To give an example, if you had waited between 2009 and 2021 for an opportune moment to invest per cash, you would have lost significantly more through the effects of inflation than you would have gained from a market crash during, say, COVID-19. In the long run, cash can become a passive investment that not only does not protect value but devalues it. Why invest when a savings account has 5% interest? Yes, 5% is high interest, but recall that it wasn't that long ago, 2009 and 2021, when interest rates were near 2.5% and savings accounts offered 0 to negative interest rates. There was talk of charging clients money if they left it in bank. In the context of long-term investment, your cash would earn nothing. That's a 12-year loss in the value of your money. Another reason is the volatility of interest rates. If Fed decides to, it can lower or raise interest rates from one day to the next, and it doesn't have to tell anyone in advance. That means you have nowhere to be sure that a year from now, interest rates on savings accounts will be 5%. What if it's 2.5% like it was a few years ago?
If you're keeping track, the 11th interest rate hike from the Federal Reserve since March of last year, and it takes the Fed's key short-term interest rate to its highest level in 22 years. And perhaps even more importantly, the Fed left the door open today for future interest rate hikes. They're just not sure they have fully tackled inflation just yet. We know that inflation is cooling. It's now at 3%, down from more than 9% in June of last year, but still not at that 2% level the Fed is looking for.
How to maintain the value of cash? The ideal way is to invest cash for the long term. On my channel Invest with Jiri, I often address this topic, and financial legends like Warren Buffett, Ben Graham and Peter Lynch will attest to this. The ideal way to invest for the long term is in an ETF such as SPY. This is a tool that replicates the performance of the S&P 500 index, which holds the top 500 US companies across many sectors. Such an investment can achieve an average annual appreciation of around 10%. Now let's examine how a $10,000 cash position would perform in an environment with a current inflation of 4% across different asset types. We have a checking account with zero appreciation, a savings account and a bond investments with a 5% return, and finally stock investments with a 10% appreciation. Note that all assets have a loss in value of $400 per year due to inflation. You don't really see it because you will still have $10,000 in your account, but in the real economy you will buy fewer goods or services with that money. Let's go to the table. For a checking account that is not interest-bearing, you will lose $400 per year, and the cash value at the end of the year will be $9,600. For savings accounts and bonds, it looks better. At 5% appreciation, I subtract $400 inflation and add $100 return. That means you will have $9,700 in your account at the end of the year. But it looks most interesting for stocks, where despite inflation you can get $600 appreciation, which would bring your original $10,000 to $10,600 at the end of the year. In real life, of course, you will see $11,000 in your account or a 10% appreciation of $10,000. What about volatility of the markets when investing in stocks? That's an important question. In today's volatile markets, it is challenging to achieve a regular annual appreciation of 10%. However, it is important to distinguish between short-term volatility, which can be observed over one or a few years, and long-term trends which can be expected with a high probability well into the future. It is true that markets can exhibit dramatic fluctuations from year to year. Sometimes markets will experience declines of up to 20%, other times only slight losses of around 3%, but there are also years when markets will achieve growth of up to 30%. It is important to note that years with positive growth are historically much more frequent than those with negative market developments. The long-term tracked average return on equities can still be attractive despite this volatility. This is mainly due to the growth of the economy and the long-term trend of rising company values in the equity markets. Investments in equities should be viewed with a long-term horizon in mind, allowing short-term volatility to be offset and attractive returns to be achieved over time. What is the main use of cash? Of course, this depends on your financial needs and goals, but the key is building an emergency fund that will cover 3 to 6 months of your expenses. This is a basic safety rule that will provide you with financial stability even in the event of unexpected situations such as medical expenses, home repairs or job loss. In addition to an emergency fund, you can keep cash in a savings account for short-term goals and plans. For example, a vacation, a car purchase or anticipated educational expenses. This cash should be readily available for you to use when you need it, without having to sell off your investment portfolio. Do you still think holding cash in a savings account for the long term is beneficial? I can't help but still see investing as the best option for preserving the value of money. It's always a good idea to rank the various assets under each other and figure out the pros and cons, applicability, realistic expectations, and also the length of the investment horizon. Thank you very much for watching to the end of the video. I will look forward to seeing you next time, and please invest wisely, especially in these volatile times.